The current financial situation in the United States and much of the world is a growing concern, one that seems increasingly difficult to ignore. There are multiple layers to this complex issue: inflation, debt, the devaluation of currency, and the impact on various investment vehicles like real estate, gold, silver, and cryptocurrencies. Understanding these issues in depth is crucial for anyone trying to protect their financial future. Let's start by talking about money. People tend to think of money as this fixed, tangible thing, a constant in their lives that doesn't really change much. But in reality, money has changed dramatically over time, and what we now call money is mostly credit, debt, and taxes. If you trace this back to 1971, when the U.S. went off the gold standard, money stopped being backed by physical commodities like gold or silver. Instead, it became fiat currency, money that has value because the government says it does. The shift away from the gold standard allowed the U.S. government to print as much money as it needed, and this is one of the main reasons why the world economy is in trouble today. The ability to print unlimited amounts of money sounds like a solution, but it creates significant long-term problems. Inflation, for one, is now a constant threat. In simple terms, inflation reduces the purchasing power of money. What you could buy with $100 a few years ago, you can't buy today. Prices for everyday goods, food, housing, gas, are rising rapidly, and for many people, this increase in cost is outpacing their wages. The Federal Reserve has played a central role in this issue. By printing trillions of dollars, they have effectively flooded the market with currency, making each individual dollar worth less over time. This kind of monetary policy benefits certain groups but harms others, particularly those who save money in traditional ways. For example, when inflation rises, the value of cash sitting in a savings account diminishes. This is why it's often said that savers are losing money just by keeping their savings in the bank. Interest rates on savings accounts are often so low that they don't come close to matching inflation, making traditional saving almost a futile exercise. At the same time, real estate is going through its own upheaval. Commercial real estate, especially in cities like New York, has been hit hard by the shift to remote work. More people are working from home, which reduces the need for office space. With fewer businesses leasing office space, commercial property values are falling, and cities that rely heavily on commercial real estate taxes, like New York, are facing budget shortfalls. As a result, local governments may respond by increasing taxes on residential properties to make up the difference. This puts additional pressure on homeowners, who are already dealing with rising costs of living. But it's not just the immediate economic environment that's worrisome. The long-term outlook for public pensions is bleak as well. Many cities and states have promised more in pension benefits than they can afford to pay, and as the population ages, this issue is only going to get worse. The U.S. has an aging population, and many of those older Americans don't have enough saved for retirement. The government will face increasing pressure to bail out pension systems, which may lead to more money printing, higher taxes, or both. In either scenario, it's the average taxpayer who will end up paying the price. Given all this, how should people protect their wealth? Traditionally, when fiat currency becomes unstable, people turn to assets like gold and silver. Gold has been considered a store of value for thousands of years, long before paper currency existed. Even today, many investors view gold as a safe haven in times of economic uncertainty. Silver, too, is a popular choice, especially since its price tends to be more volatile than gold. It's a smaller market, which means it can move more dramatically, both up and down. Right now, silver is priced significantly below its all-time high, making it an appealing investment for those looking to hedge against inflation or currency devaluation. Gold and silver are tangible assets. They have real intrinsic value. Unlike paper money, which can be printed at will, there is a finite amount of gold and silver in the world. This scarcity is what makes them valuable in the long term. While they don't pay interest or dividends like stocks or bonds, their value tends to rise when the value of fiat currency falls. For those who are looking for a hedge against inflation and uncertainty, precious metals are an appealing option. Cryptocurrencies like Bitcoin are another asset class that has gained traction in recent years. Bitcoin operates on a system that is fundamentally different from traditional fiat currencies. There's a fixed supply of Bitcoin, which means it can't be printed or inflated the way dollars or euros can. This characteristic has made Bitcoin attractive to those who see it as hard money, much like gold. Moreover, Bitcoin's decentralized nature makes it immune to the kinds of manipulations that central banks can impose on traditional currencies. The Federal Reserve can continue to print money, but Bitcoin's supply is fixed, which means its value could rise as fiat currencies devalue. This scarcity is one of the reasons why some financial experts believe that Bitcoin will continue to grow in value over time, particularly as governments around the world continue to engage in expansionary monetary policies. Unlike gold and silver, however, Bitcoin is digital and still relatively new, which makes it more volatile. This volatility can be a double-edged sword, offering the potential for massive gains but also significant risks. It's also worth noting that the current stock market is not the safe haven it once was. The Federal Reserve's policies, which include artificially low interest rates and trillions of dollars in stimulus, have helped to inflate the stock market to unprecedented levels. In many cases, the rise in stock prices has little to do with the actual value of the companies themselves, and more to do with the fact that there is so much cheap money available. CEOs have taken advantage of this situation by using corporate funds to buy back their own stock, which inflates the price even more. While this may make the stock market look strong on the surface, the reality is that it is sitting on a bubble. The risk of a market correction is high, and when it happens, it could be severe. Investors who have their money tied up in stocks may see significant losses when the bubble bursts. This is why diversification, spreading investments across different asset classes, is so important. Relying too heavily on any one investment, whether it's stocks, bonds, or real estate, is risky in the current economic climate. Debt is another factor that is dragging down the economy. The U.S. government has taken on an enormous amount of debt over the past few decades. As of now, the national debt exceeds $30 trillion, and there doesn't seem to be a clear plan for how to deal with it. When a country accumulates debt at this level, it limits its ability to invest in other critical areas, such as infrastructure, education, or healthcare. Eventually, this debt has to be paid back, either through higher taxes, reduced government spending, or more borrowing, which just compounds the problem. The student debt crisis is also worth mentioning. Over the past 2 decades, student loan debt has ballooned to over $1.7 trillion. Many young people are entering the workforce with massive amounts of debt, which limits their ability to buy homes, start businesses, or invest for the future. The burden of student debt is not just an individual issue, it has broader implications for the entire economy. When a large portion of the population is shackled with debt, their ability to contribute to economic growth is severely hampered. The combination of these factors, rising inflation, unsustainable debt, a weakening dollar, and an overinflated stock market, suggests that the current financial system is on shaky ground. People need to start thinking strategically about how to protect their wealth. This is why many experts advocate for a diversified approach to investing, one that includes a mix of traditional assets like real estate, stocks, and bonds, as well as alternative investments like precious metals and cryptocurrencies. Real estate, in particular, is often seen as a reliable investment, but it too has its challenges. Commercial real estate is facing significant uncertainty, and residential real estate prices have risen dramatically in many areas, creating concerns about a potential housing bubble. Investors need to be cautious and selective about where they put their money. Real estate can still be a strong investment, especially in areas where demand for housing remains high, but it is no longer the surefire bet that it once was. In times of financial uncertainty, knowledge and preparation are key. Understanding how money works, how inflation impacts savings, and the importance of diversifying investments is crucial for anyone who wants to secure their financial future. The financial world is changing rapidly, and those who fail to adapt will likely find themselves on the losing end. Whether it's through precious metals, cryptocurrencies, or carefully chosen real estate investments, there are ways to protect wealth in this volatile environment. However, doing nothing is not an option, especially when the economic landscape is shifting as quickly as it is today. What's happening now is not just a short-term blip. It's part of a broader shift that will reshape the economy for years to come. Those who understand this will be in a much better position to navigate the challenges ahead. The question is not whether there will be change, but whether people are prepared for it.